Hey, what is going on YouTube? Welcome back to another video. In this video, I'm going to be breaking down what in the world does cap rate mean. Now, I talk to hundreds of investors throughout the country in all different levels, ones that have bought thousands of units and then investors that are just getting started in the business. And one of the most confusing words for most investors to understand is cap rate. It's not necessarily the definition of cap rate because everybody can go look up what it means at the end of the day. It is the application of how you use cap rate that so many people get confused on. So I'm going to be breaking down exactly how I've used it to acquire over $50 million and how we helped hundreds of investors on the inner circle do deals across the country. So with that being said, let's go ahead and let's jump in. Again, by the end of this video, you're not only going to know exactly what cap rate actually is, but the most important piece is how to use cap rate as the investor. Just simply knowing what the cap rate is on a deal is not going to get you enough information to make a decision with confidence. Most people think that the cap rate is the return on investment, and that's simply because that's the definition. If you bought a piece of real estate using no debt, the cap rate that you're paying is the return on investment that you're going to get. Now, here's what investors like myself actually use cap rate for to understand the two most important metrics of a deal, which is number one, your value, how much value can you create to the property, and then your risk, how much downside is there and how do you mitigate it. So now let's spend some time on the actual definition, like what does cap rate actually mean? Again, this is more of the definition, not the application of it. So all cap rate is your return on investment if you're not using a loan. Meaning, let's say we have a $10 million building and you're paying a 6% cap rate for that property. You would take $10 million, multiply it by 0.06 to solve for your net operating income or all of the net cash flow from the property after you're done collecting the rents and paying the expenses. So $10 million building with $600,000 of net operating income means you're buying a 6% cap rate. Now, when I first started at Marcus & Millichap back in 2019, one of the most important things that they taught me, which is what I refer to as the golden triangle, these are three metrics that if you have two of the three, you're always going to be able to solve for the third. So kind of like moving out of the definition of cap rate and how you actually use it into the business is going to be starting right here. So we have three metrics. We have value at the top. This is the value of your building. What dictates value is cap rate and NOI. So we have cap rate on the bottom left, we have NOI on the bottom right. In the last example, we have all three of them, but let's take out one of them just so you can see how it would work because they're always interchangeable. As long as you have two out of the three, you can always solve for the third. To give you an example, let's say that I know that I can afford to pay a 6% cap rate, and that's mainly based on the interest rate environment, which is a completely different video itself. But I can pay a 6% cap rate in today's environment, and a building came out and it produces $600,000 of net operating income. To solve for the value of the building, because I have two of them, I have NOI and I have cap rate, I can now solve for the third by taking $600,000 and dividing it by 0.06%. You'll get a $10 million value. This is going to become extremely important when you're starting to look at deals and figuring out how much upside there is on the property. You're going to take the NOI, divide it by a cap rate to figure out for the value. This is super important. Now, the last thing I'm covering here before we move into the mistakes that a lot of you guys make is understanding the risk and reward spectrum. Now, whenever you make an investment, generally, the higher the risk that you take, you're expecting a higher return because it wouldn't really make sense for you to take a very high risk investment and expect a very low return. So these things are always interchangeable. And so the cap rate that somebody's willing to pay is a very large indicator of how much risk there is at the property. So generally speaking, if you have a higher cap rate property, yes, that means that there's more cash flow out of the gate, but it doesn't necessarily mean that it's a great property. Oftentimes, the reason that somebody would value their property at such a high cap rate is because it's in a questionable location. Maybe you're in a questionable area, not with the best quality tenants who actually aren't paying every single month. But you also are in the business of making money. So you have to find a sweet spot. And I'd say our sweet spot as investors is anywhere between, call it, the 5 to like 6 to 7% range on a cap rate basis. Now again, I'm in the state of Florida. Maybe if you're in the Midwest, you might be looking at 6, 7, 8%. But I'm not going after and I'm not chasing 20s and 10s because these things are the worst conditions. I have so many people in our community that jump into these terrible properties because they're marketed at such high cap rates, all to find out there's a ton of work, ton of things that you don't know about, and a lot of risk that you're taking in. So I like to be in the mid to maybe upper 65, 70 percentile of risk, because you can manage it very well. We're in real estate. It's not like you're going and buying crypto or anything. You're buying a tangible asset with contractual leases in place. So it's a very low risk business in comparison to other investment vehicles there are. Then I'm looking to match that from a return standpoint as well. So if I'm going to go into a lower cap rate property, I'm going to have a lower risk adjusted return. So now that you have an understanding of what cap rate is, like from the definition standpoint, it is the return on investment if you don't use debt, which 99.9% of the time you are going to be using leverage. So that's like the number one reason I hate why people assume that's the only way that you use cap rate. It is not just a return. And you understand some of the nuances between like the golden triangle and then placing where your investment lies on the risk and the reward chart. So now we're going to move into the mistakes that you are making while looking at cap rates. So the number one mistake that most investors make when considering cap rates is they only buy on a cap rate. This is one metric in a deal, and it's not the most important one, let me tell you. But if you're one of those guys that go out and just say, I don't want to look at anything less than a 10 cap, you will never buy a deal. It is very tough to go out and find deals that are north of 10 caps that you won't have to take a gun to collect rent with. I'm telling you, don't be that guy. And the reason I say this is because I can make sense of overpaying and paying a lower cap rate in place today in comparison to where the market is if I know that there is a ton of upside or value to be created at the property. I know if you're only looking at one metric, you're not looking at the overall deal, and by default, you're missing a ton of opportunity. The second biggest mistake kind of ties into the first one, which is you only want higher cap rates. I know investors that won't touch the state of Florida because they're like, oh my goodness, deals are trading in the 5s and the 6s, and they want to go out and get an 8 or a 9. They're going to go into the Midwest. I'm going to stay in Florida. They think because it's a 5 or a 6% cap rate, it's not a great market to be in. And it's most likely because they're only considering one component, which is the cash flow. What you fail to see is the supply and the demand imbalance that we have here being in Florida. Our collections are at all-time highs. We can charge fees. We have $200 to $300 rent increases that you don't have other places. And you can make so much more money by increasing the income and then selling at a lower cap rate, which we'll show. We'll actually go through in a very quick second an example of why you actually don't want to be in a higher cap rate environment. Because if you can move rents by $100 on all of your units and you divide it at a 5% cap rate versus a 10% cap rate, you can make so much more money on the total deal by going into a lower cap rate market, moving the income the way that you should, and then selling it at a lower cap rate as well, opposed to just going into questionable locations for higher cap rate. And the third and largest mistake that most people make, and all of this kind of fits into one, which is they don't consider the value add component. Meaning you buy deals on just the cash flow today and any extra rent increase is great. And while that works, because there is no right or wrong in the business, I see a lot of deals trade. I see people who do really good. I see people who just do okay. Most real estate investors think about cash flow, but what oftentimes you're not considering is how fast can you grow your principal to a large enough amount to pay enough cash flow to support the life that you want. Meaning if I can turn 100 grand into 200, 200 to 400, 400 to 800, 800 to 1.6 million, I can place that 1.6 million and earn 200 grand a year. So the question is, how long does it take for you to get to $1.6 million of principal? By learning how to force value to a property, you can compress the timeline and roll your money so much quicker. I'm just telling you, these three things: only buying on cap rate, thinking that you only want a high cap rate environment, and then lastly, not considering how much value you can add to the property by increasing the net income, are the biggest mistakes that I see investors make. Do not be these people. And all of that leads into, how do I use it? So as an investor, again, we've acquired over $50 million of multifamily deals, over 337 units at the age of 27. We run a community, quick plug, the Deal Room community. We have a completely free tier. There's no credit cards, nothing needed to be a part of it. We have thousands of members across the country. And then we have an inner circle tier where I'm personally working with all of our members to get deals closed. So I see a lot of deals happen personally and across the entire country, These are the ways that we use cap rate as investors. The number one thing that we focus on is risk mitigation. And understanding your going in cap rate is a really big tell to what price you're paying in comparison to the marketplace today. So we're going to go through three different things. You see it. I have green, yellow, red. You want to be in the green. Yellow is okay. Red is a big no-no. Or if you are, you have to understand the risk that you're taking on because it's a completely different game. I'm going to break down positive, neutral, and negative leverage. This is a metric we look at as investors, because the reason that real estate investors like us go out and get a loan is because we want debt to work for us and not against us. If it works against us, it would make sense for us to just go buy these properties all cash. But because the US government is the way it is and the economy is the way it is, we as real estate investors love to go out and use leverage. Let's go buy buildings without having to use all of our own money. The big metric that I look at is positive, neutral, or negative leverage. How do we figure this out? You have to know your income, your NOI, because again, NOI divided by purchase price equals your cap rate. If the cap rate is greater than the interest rate that you're borrowing money at, you have positive leverage. Meaning if I'm buying a $10 million building and it has a 6% cap rate or $600,000 of net operating income, and I'm going to get a $7 million loan and I'm borrowing the money at 5%, that means my cap rate is greater than my interest rate, and that is a good thing. That means I'm going to have more cash flow than I would if I bought it all cash by using debt. So generally speaking, this is where you want to be if you want to de-risk your investment. This is a good thing. Now, neutral leverage is exactly what it sounds like, meaning it's equal to. So same example, let's say I have a 6% cap rate and I'm borrowing money at 6%. That is a neutral deal. That is on the yellow line. You're okay if you have enough upside in it. Now we're moving into a red flag or an indicator on the deal that you're arguably paying too much for the property because debt is working against you, meaning the cap rate that you're paying. Let's say I was paying a 5% cap rate and I was borrowing money at 7% for the interest rate. I would have a lot of negative leverage. This is, again, an indicator in the deal that it's priced too high, or there's something that we're not seeing. Maybe there's a ton of upside, but just understand if you're in this red area, you are in a higher risk environment, opposed to if you were in a green area. That's why I like very simple green, yellow, and red. You want to be between green, yellow, maybe a little bit of orange. The second way that we use cap rate is by far one of the most important ways to use cap rate, and it's understanding the upside. So after you've determined how much risk is on the deal, I'm a big believer in figure your risk out first and then look at your upside versus looking at your upside and then looking at the risk. It makes you such a better investor in understanding it that way. So we understand the risk. Now I'm going to how much upside is there. So I look at NOI divided by cap rate equals value. This is, if you learn anything from today's video, take this down, write it, understand it, maybe even give yourself a tattoo of it. It is that valuable of a formula to know. For example, let's say we had a building that produced $100,000 of net income. Let's say it's a 10-unit building and it produces $2,000 a month for each unit. That's 20 grand a month. Times 12 is $240,000 a year. And let's say it takes $140,000 of expenses to operate the building. It has $100,000 of net operating income left. If you take it and you divide it by a 6% cap rate, the value of the building would be $1.66 million. Now, just that alone, like, how do you know if that's a good deal? You can't. You have no idea if it's a good deal because you're not looking at really what could it be worth. Like, if you're a home flipper, you're not only looking at the purchase price, you're looking at purchase price, all-in rehab, and then total repair value. Like, that's how it kind of works in real estate. Same thing here. So let's say we bought the property, we pushed the rents a little bit, and we moved the bottom line from $100,000 to $150,000 of NOI. That NOI divided by the same cap rate means our new value is $2.5 million. We added $800,000 of value to achieve it. Understanding the gap between what basis you're paying for the property and where you can take it to after you're said and done is where all of the money lies. That's how you make decisions. For example, here's a 28-unit deal that I partnered on with a member of our Inner Circle community named Noah Sanders. He found it, did the underwriting on it initially, brought it to me, we partnered, I raised all the money, made it super easy. Now we're doing the work together. Let me show you it. So it was 28 units, we bought it for $3.9 million. The in-place NOI was $260 grand. This is a big tell. What did I pay? Was it positive, neutral, or negative leverage? You take 260, divide it by $3.9 million. Our going in cap rate was 6.7%. That's very tough to find in the state of Florida. We stole it. This guy was in default when he was selling. We bought it at a 6.7 cap rate and we financed it. We got a $2.9 million loan at 6.25. So we have all in all plus 50 basis points of positive leverage. That is a good thing. If it was negative, it'd be a different story. If it was neutral, it'd be like, okay, cool. How much upside is there? So this is the acquisition. This is a good tell that we bought it at a good price. Now, how do we make a decision on the deal is how much upside is there and what are the returns to the investors? We believe there's $300 of upside at the property. All this means is we're gonna move our in-place NOI from 260 to a future NOI of 360. We're adding $100,000 to the bottom line, divide it by a 6% cap rate, and the value of the building is $6 million. So we bought it for 3.9, put 400 in, so we're all in at 4.3, 4.4, and it's worth $6 million when it's said and done. Now, with the way that we structured the profit splits with the investors, it makes a lot of sense for them, and then me and Noah get to personally pick up 200 to 250 grand each. And this is how we'll wrap up today's video with the bottom line. Like, bottom line is, how do you actually make decisions using cap rate in place? It's understanding the risk-adjusted returns net to the investors. Like, for example, we did a 70-30 profit split with the investors. There's about $1.5 million to split after everything's said and done. We give them $1 million, we take $500,000, everybody's super happy. So we're looking at the risk-adjusted returns. How do you dictate risk? Well, what cap rate are you paying? What kind of debt do you have on it? Where can you take it to? How much execution risk is in the middle? And then once everything is said and done, what is the total annualized return to the investor between both the cash flow, if there's any, plus the appreciation upon a sale over what period of time? That is how you actually use cap rate. If you believe you're going to use the definition version of cap rate to actually go out and like apply it and try to do deals, you are going to face what every investor faces, which is a ton of confusion. And if there's confusion, I know you're not taking action and submitting offers. So hopefully you got the clarity that you needed on what exactly cap rate is in today's video. If you could do us a huge favor, help us grow and find more multifamily investors by making sure to drop a like, comment, subscribe. And most importantly, if you're not already in our completely free multifamily investing community, the Deal Room, all you have to do to sign up, it's literally free. You can meet thousands of investors across the country and learn a ton of information by being in there. Check out the links in the description, find your way there, complete your profile, introduce yourself to the community, and I can't wait to see you on the next one.